In this video, I'm sharing the latest trade in my TROW wheel strategy, where I use cash secured puts, covered calls, and dividends to generate income and lower my overall cost basis. Rowe Price is paying a cash dividend this month that will bring me over $400, but that wasn't the deciding factor in today's trade. What really shaped my next move was the batch of 110 shares I bought at $92.58. They brought down my average price per share, but not enough to comfortably sell a call above break even on the whole position. That left me with a choice. Do I treat those lower price shares as a separate lot for strike selection, or do I look at the big picture, my total average cost, and accept a lower premium in exchange for avoiding the risk of being assigned at a lower strike? In the end, I sold my third $95 covered call, this one expiring July 18th, staying consistent with my Double Ferris Wheel Strategy, keeping the income flowing and giving the position some time to recover while keeping some shares uncovered for the FOMO. I'll walk you through the trade details, thinking aloud during my decision-making process, and show you how I'm managing the math as this position evolves. The share price of TROW today is $93.28, and I have 360 shares in the account. Last Friday, June 20th, my covered call with a strike price of $95 expired out of the money, so I realized the entire $154.34 in options premium without needing to roll the position. I changed that row to pink to show that it's closed, and today I'm going to be selling a new covered call on Rowe Price, and I need to choose an expiration date and a strike price. The ex-dividend date for Rowe Price was June 13th with a dividend of $1.27 per share, and the payment is coming on June 27th. So on that day, $419.10 in cash will come into this account. That dividend cash payment will reduce my average investment per share. So the decision today is how to set my strike price for this covered call. And to do that, I need to make a decision about how I'm thinking about the 100 shares that I am using to cover this call. If you look back at the trade history, you may remember, especially if you've been following this for a while, my original purchase price for these shares was $117.86. And the share price today is just over $93. So the shares in this position have really decreased in value. If you are learning this for yourself, I have both free and premium resources on my website, video playlists, downloadable tools, books, and coaching. If you want more support, the link's below. I started trading TROW in January of 2025 when the share price was $117.86. So I bought 150 shares and sold a covered call and a cash secured put at that time, and then was assigned to buy 100 more shares, paying $115 for them. Since then, I received a $317 cash dividend payment. Then, because the share price had declined so much, I decided to start a new wheel position with a lower strike price. So I bought 110 shares at $92.58 and sold a covered call with a strike price of $95, and then I rolled that call again. So I brought in a little more than $300 in covered call premium using the 100 shares that I bought at $92.58 as the collateral. So today I need to decide if I want to continue thinking about those 100 shares that I bought for $92.58 separately from the rest of the position. Even with buying these lower price shares and bringing in covered call premiums, using them as collateral, my average cost per share is still almost $107. I'm going to look at strike prices that are above my overall position break even and see if I can find anything that brings me enough income to be worth trading. But I also may continue to look at this lot of 100 shares separately from the rest of the position. Looking at the July 18th expiration date, which is 25 days from today, I could sell another $95 covered call and bring in at least $160. I could increase the strike price to $100 and bring in about $25. If I go out to August, I could again sell a $95 covered call and bring in $320. At the $100 strike price, I could bring in $125, and if I go up to $105, I could bring in $30 or $35. I'm going to look at September, even though I really don't like selling that far out. Here, the $105 strike would bring me about $75 or $80. The next ex-dividend date is probably going to be in the middle of September. So I'm going to look for dates in July and August for these trades. The last thing I'm going to consider here is this $419 dividend payment that's coming in. If I divide the $419 by the 360 shares I own, I can see that I'm going to have an improvement in my overall position of $1.16 a share, which will bring my adjusted cost per share down below $106. But looking at the numbers here, I really think I'm going to need to continue thinking about these 110 shares that I bought at $92.58 as a separate lot. If they are called away from me, as long as I profit on those shares, I'm going to be okay with it. So that said, I'm going to look at strike prices of $95 to $100 in July and August and choose this next trade. July 18th, $95 strike, $155 income, $100 strike, $25 income, and August, $320 or $125 with the possibility of an additional $500 of capital gains. Any of these four trades would improve the position. So my decision is, do I want to maximize my options premium, or do I want to leave open the possibility of higher capital gains? If I sell in July, I would definitely choose the $95 strike. And if I sell with an August expiration date, the 95 or the 100 would be okay. I'm going to choose the $95 strike expiring July 18th, and if it goes in the money, or if the contract is assigned and the shares are called away from me, I will just wheel it by selling another cash secured put. I'm going to ask for $165. It filled at $175. The current share price of $93.32 is higher than the price that I paid for the shares when I bought them. So I'm going to use this higher number as my collateral value. A $174 premium on $9,332 in 25 days gives me an annualized rate of return of 27.28% on this trade. I'm going to sum all of my expense and income to date, and I'm going to go ahead and include this upcoming dividend payment that I know will be in the account in just a few days. I bought 150 shares, sold a covered call, sold a put, was assigned to buy another 100 shares, received a dividend payment, bought 110 shares, sold a covered call, sold another covered call, and sold another covered call, and here's a dividend payment. My adjusted cost per share is $105.13. The net liquidating value of the account right now is $33,415. If I compare my total expense and income to the net liquidating value, I still have an unrealized loss in this position of $4,432, but it is a smaller loss than I had last time I checked on April 17th. This is one of those trades where I know my choice was completely reasonable and I can live with the outcome, whatever happens. But on July 18th, we'll find out whether it turns out to have been the best choice or not. If you want to follow along and see how this position plays out, be sure to subscribe and let me know what you're trading.